let's just start with this mammoth. You know, it's right here in the room. Look at the charts. I mean, this is crazy stuff.
Upon the breakout, gold's going to make a new all-time high.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
Hey, welcome to Live from the Vault. My name is Shane Miranda, and I'll be your host for this episode. I am excited and fired up to go over to the UK talking gold with Andrew Maguire. Why is that? Because he just actually came out of the vault, and we'll be hearing about that and a whole lot more on this week's episode. Just before we go over to Andy, let's remind everyone, we love the community. We're growing really rapidly. Make sure you hit that subscribe button if you haven't already, and then hit the like and the share, of course, with as many people as you know. And the last thing that I want to just remind you of, if you want to hear about these updates in real time and if you want to be notified, just hit the bell and you're good to go. So let's go over to Andrew Maguire of Talking Gold. And Andy, I know that you've been in the vaults and you're going to share that with us. But just before you do, can you just kind of recap what's been going on in these kind of upside down, crazy markets over the last 2 weeks?
Yeah, nice to be with you again, Shane. And I'll tell you something. When we start talking silver, I know your excitement levels always goes through the roof when we talk about silver. But oh my goodness me, I'll tell you what, Shane. This week, you know, standing on pallets and pallets of wholesale bars, I just wished you could have been there. But we're going to share all that stuff with you very, very soon. I mean, literally, we just got back late last night. There's a lot of editing to do. In other words, you know, the films all have to be uploaded and one thing and another. I'm not a technical guy. All I know is that we're going to be able to share this with you soon, and I know you're going to go berserk. But, you know, you've just mentioned a question, which is basically, you know what, this is the mammoth in the room, isn't it? I mean, let's face it. Look, we're experiencing a massive race at the moment to look at the markets. I mean, they're so volatile. I mean, the counterintuitive nature of gold and silver. And we're going to talk, you know, this is not pie in the sky. This is, we'll give you the wholesale market view and why we know this is absolutely short-term stuff. What it is it's a massive race, really, to exit unallocated gold accounts before the end of the year. Now, what we discussed this before a few times now, it's a two-edged sword initially. And I'll explain, though, what ultimately this short-term action, it is long-term, very constructive. So let's just start with this mammoth. You know, it's right here in the room. Look at the charts. I mean, this is crazy stuff. I mean, just now we see a report that should be bullish for gold. And what does it do? It does the exact opposite. What we're seeing selling into the fixes. There's reasons for that. And the paper gold and silver selling in both gold and silver, it's futures centric. And these footprints clearly point to the COMEX. And although all sectors really headed into yesterday, we had the Fed meeting yesterday. I mean, most people were on their hands before that. So really any action before that was really the algos chasing each other. But you know, really all the sectors heading into yesterday's Fed meeting, they've been kind of skittish. I mean, what we all find really frustrating about the action, though, in gold and silver is over the last 2 weeks is that the selling in both gold and silver is blatantly counterintuitive to the very strong underlying physical market, where conversely, and as wholesalers, this is, in fact, the less you know, the easier, because really we see this enormously strong physical market. Then you look at this and it actually drives you crazy just to think, how on earth, how many fools are in there adding paper supply and allowing this game to continue? And really, we're looking at refiners commanding into these sell-offs, commanding expanding premiums over this paper-determined spot price. I mean, if you want any size at all, you are going to have to wait, and if you are going to have to pay a price over and above this paper price. Now, we've got to remember that silver is captive to these same actors who are assisting and being assisted by the Bank of International Settlements, the Fed, obviously, in ditching. What their mandate is to ditch as many unallocated over-the-counter foreign exchange gold contracts as disruptively as possible, of course, as we move closer to Basel III compliance in just, goodness me, 16 weeks now. And it's important to underscore, though, just what is really happening here, short and long term.
All right. Hey, Andy, now you had just mentioned a little bit about the vault, and I don't want to, I don't want you to let everyone hanging here because I'm fired up and excited about what's going on in that vault. Maybe we can break it down. What can you share with us? And another question, do you think it's a good time to buy physical right now?
Well, look, this actually, yes. Being in the vault, and I would say it's a bit akin to, if you look at a beautiful car on the TV and it's there it is, and you kind of look at it and yeah, it's nice. You go into the showroom, it's a whole different story. It's real, it's there. Oh, suddenly it's kind of attractive, So, and I think being in this vault, it really does provide a perfect example. You're in a physical environment, and as you say, I was in our state-of-the-art Kinesis vault on Monday, our silver vault, that is, and we moved into our gold vaults, which we'll talk about at some other time. But really, we're talking about silver here in particular, because silver provides a much better example of how counterintuitive this market is. And while we were there, we just happened to film about 25 tons of 4/9 wholesale 1,000-ounce physical silver bars coming into our Kinesis silver vaults to back your silver currency. Now, the filming of literally tons of incoming pallets of wholesale 4/9 bars being processed and vaulted. We're going to release this in our upcoming 50th episode, which is coming pretty quick, amazingly. But do you know what? This actually may be the first time some of you will have ever seen a 4/9 wholesale bar versus a 3/9 silver wholesale bar. And let me tell you, that little bit of excellence that we strive for to make to bring in as many 4/9 wholesale bars as possible, they're just beautiful. When you look at a 3/9 bar, it's lovely. A 4/9 bar is beautiful. Now, really, I've got to say thanks to all of you there's just some of what we just saw was just some of the hundreds of tons of supply you are helping to remove from the market. Now, we always knew that silver has always been the house insider's Achilles heel. Yet they can play gold a lot easier than they can play silver. And the reason is because while gold has traded at around 100 ounces of paper transactions for every single ounce of underpinning it, silver has been closer to 500 to 1. And that's 500 times as many paper claims on against each ounce of silver. So by you buying silver last week alone, just that 25 tons we filmed, together, what we've done is neutralize close to 12,500 tons of paper silver, guys. That is huge. Now, what I'm saying to we as stackers, by taking physical off the market, are using the power of physical against the house rig game. Now, given just what we physically vaulted for you on Monday equals 12,000 odd tons of paper silver, and that is, think about this, that's how much silver is cleared and netted out on the books of the insider banks on a daily basis. When you think of these things and you realize just how big and heavy these bars are, and how when these are not leveraged bars, these are fully allocated real bars, and you suddenly realize that we, as stalwart stackers, whether we're buying an ounce or a ton, we've got the power of inverse leverage to win this long game. And in fact, just to illustrate just how counterintuitive this recent paper silver sell-off, and gold, of course, has been, but silver, we have been in fierce competition against the same insiders who have tricked the house punters into selling their positions. We've been in competition with these guys to secure physical wholesale bars from the global refinery. So give you a bit of an insight as to what's really gone. It's so much so, yesterday, one of the largest refineries we deal with advised us, hey, sorry, we've only got 70 tons of wholesale bars left to sell for the rest of the year. Now, okay, this is one refinery. This is having a knock-on effect into the supply chain. And there's only one answer. If you keep swapping your paper for physical, the price will have to rise until someone is happy to sell it to you. Hey, it's called supply demand. Amazing that we've not seen that for 50 years in silver or gold under the COMEX rigged game. But under the radar, while paper traders are literally psychological operations, psyoped out of their undeliverable positions, hey, good riddance, guys. Physical silver is actually experiencing off-the-scale physical demand. And given this tsunami of massive paper to physical divergence, silver is going to rebound strongly from an actionable, arbitrable, deeply oversold level. So, in other words, look, this time, the next rally is going to be triggered by short covering.
Andy, it reminds me when you're talking about silver again, you can take 200 ounces, let's call it $5,200, $5,200 US dollars, and drop it on the floor. You can even throw it on the floor and not much is going to happen. But you take 200 ounces or 200 or two 100 ounce bars and you just drop it, you could break your foot with that weight. It's just amazing the difference there. Now, but let's go on with. I know, Andy, in the last couple of weeks, there's been a lot of questions coming your way, and maybe you can give everyone a global kind of overview, a bigger picture overview moving forward. And is this a good time to be buying physical right now?
Do you know what? And the key word is, of course, physical. I would never suggest anyone go in the paper market and play that game, borrowing money from the house and then showing them your balance sheet and saying, well, here's how much I could afford to lose, but give me the chips to that degree. Oh, and let's go and play your game. Oh dear, wonder why I lost all my money. I mean, so no, yes, physical. And this is what we always talk about, physical. Here and now, I mean, really more immediately, we had the Fed yesterday. Okay, so everyone was waiting for the Fed. And, what do we do? Do we buy? Do we sell? Should we sit on our hands? Look, the Fed sent some mixed messages yesterday. You can't ignore this. And of course, they telegraphed this hawkish stance. Look, these taper threats to us and to a lot of people that I deal with in this marketplace, they look very sketchy. And while stocks are still pricing this in and rallying back, you can see them rallying back at this point. I mean, that may change, but as far as gold and silver is concerned, the bearish stance leading into the Fed, where we see all this selling going on ahead of time, and this is contrived, because you can take any uncertainty, and this is exactly when the insiders start to game the market. Uncertainty, do a little bit of bid pulling, create a bit of a dip. Everyone questions, it must be something terrible going on. No, they've just set you up. But what's happened is, as we moved into the Fed, this bearish stance, the Fed's bearish stance, is already baked in. And especially when we look at the physical market, it's baked in. And while momentum sellers continue today, and we can see the momentum sellers, it's worked, so let's keep doing it until I'll be wrong at both ends. But hey, here it goes again. Look, you have to remember, both gold and silver are deeply technically and fundamentally oversold in every single aspect. Now, from a trader's perspective, and I know we have some traders here, so please bear with, but with the paper market having overrun fundamentals, basically, supply-demand fundamentals, it's inevitable that one of the currently capped upside breakout attempts will succeed. Now, there are certain levels which they're capping. You wonder why. Why is it silver doesn't go above this level? And there's no actual reason. It's because it's a technical level, and at some point they're going to break out again. It's inevitable, of course, it will. Now, structurally, at this point, after this much selling, it's far more attractive for insiders, the house, the commercials, to hunt out large accrued short stops to flush versus really hunting out really what are very already tapped out long stops. So in other words, you've got so many long, people who are sitting in an undeliverable contract. Oh, let's speculate on the price rise. Oh dear, better get rid of them. And then once you do that, these guys go short. In other words, they will take a position, borrow insiders' silver, and sell it into the market. Oh, great if it goes down. But what happens is it goes up. So they would have stops above the market. So you come to a point where, yes, if there's a lot of froth and people are jumped in and speculating on a higher price, it's easy to flush them out. You know where they are. You hold the book. You know exactly where their stops are. You know how much margin they have, how much they've borrowed, and how much they can afford to not borrow. And out they go. Comes a point where those lines cross. Now you've got the inverse. You've got a very large amount of sellers who have no ability to deliver. And these are not insiders. If the insiders are not going short here, they are pulling bids and allowing all the speculators to do all the work. And then what happens is you get to a point where it's far more attractive to rinse their stops on the upside. So that I'm thinking, so basically, as we move into season now, further into season, and we've got obviously Basel III short covering must commence into the end of the year. I think that given the deep backwardations, we've talked about backwardations before. All a backwardation is simply that the futures market is it's running at a cheaper price to the much largest foreign exchange market. So in other words, gold foreign exchange cross, which is long gold, short dollar, versus the futures price of gold, or silver. So if that's running less than the real tradable over-the-counter price, then obviously we call that backwardation. That screams at us that we see this right across the curve into December, in every single contract into December. We know that insiders will be taking the long side of every single sell order, which are clearly speculative and grossly divergent to the strong, coiled physical market.
And Andrew, as where we are right now, and maybe you can go over the bigger picture, and I know that we've got a ton of questions from our subscribers that are asking. Can you maybe just talk about the bigger picture moving forward?
Yeah, and I think that's great because that's really all that counts here. And especially if you're a stacker, you're not borrowing money, so it is important to look at this bigger picture. And look, I will start by answering what is really a distilled aggregation of multiple questions, really, about really boils down to who exactly is behind the current counterintuitive price action. Hey, we're seeing this right now into such a strong physical market. So let me just clarify just who the participants are into the disruptive as possible unwind of these unallocated over-the-counter gold positions as we lead into Basel III, because it is the paper gold unwind that is largely actually responsible, ironically, for the short-term counterintuitive volatility that we're seeing. And as we've warned, we've warned that this would happen. We expect it to some degree, but not to the degree that would be sufficient to drive such deep, actionable backwardations in both gold futures and silver futures. So how it works and who the actors are is really this. It's basically the entire BIS coordinated effort has just one mandate. That's through all of this, there's just one mandate to cover off as many unallocated leased gold positions that expose the Bank of International Settlements underwater physical site accounts, their physical accounts, to a mismatch if they're not squared by December the 30th. Now, this gold let's remember, does not belong to the Bank of International Settlements trading desk. It's being managed for other central banks who are really trying to get a return on their gold. But more importantly, now the line has been drawn, an actual return of their gold. And so really, this is, and we've seen problems. We've seen Germany asking for 300 tons. We've seen, it'll take 7 years. I mean, come on. You know, we all know there's rehypothecations. We all know there's been leasing. And you know what? Basel III is going to actually address this. And we're seeing a real unwind. And we see that often into a fix, like we did today. We've just seen a spike down into the fix. Why? Because you can get maximum traction that way. In other words, you're covering off at the lowest possible price an unallocated gold position. Now, these positions, these swapped gold, leased swapped gold, has never left their site account. It actually sits in unallocated form on the balance sheets of these market-making bullion banks who have gold accounts with the Bank of England. So we've talked about this before, but to square, and so really what's it enabling them to do, what we're witnessing is a mandate to as best as possible enable these bullion banks to square off as many of these mismatched positions so they can repay these bank loans as low a price as possible without an excessive bailout. Now, we do see the ability to still square off any residual mismatched positions into Basel III as we get closer to December 30th. And that can be done by way of a keystroke. And these banks will never fail because of that. But it will also drive the price higher. So I think it'll be done before I think this sort of balance will happen before the last minute of the end of the year. Now, it's the planned timing of these orchestrated bid pulling efforts that we talked about. And they do it at well-known trend line, moving average positions, and then suddenly you get these sell orders. These are obvious to traders, far too obvious. So therefore, if something happens at something like that, and you pull, as a market maker, it's your duty, it is your mandate to make sure that you keep a liquid market. You're on both sides of the market. You make sure that there's a balance, that the bids and the asks are reasonably matched. You start to, as a market maker, and you collude with each other to pull bids, and you've no longer supported that market. So what's going to happen? It's going to just collapse into that air pocket. And that's pretty much what they're doing. They're not short selling. They're actually taking, and even though you might see on the COT report that they have swap dealers have accrued some positions, bet your life, these guys are not exposing any of their physical. They are definitely hedged in the over-the-counter market. And I know people not everyone understands that, but we deal with first-tier banks all the time. They're busy buying gold and silver in physical form, and they will not expose any of that. They don't want to sell any of that to you or anyone else at current prices. So really, that's what we're seeing. So these sell-offs are directly coordinated by the trading desk in Basel, Switzerland. Footprints evidence these waterfall sell events as really directly attributable to them. I mean, we recognize their footprints, usually 6 a.m. in the morning or very early hours in the morning. And look, the BIS is tasked with, we think it's somewhere around 380 tons of unallocated contracts still remaining over the next 16 weeks. Now, we expect actually an additional 60 to 70 tons were removed from this figure so far this month. However, this effort in gold looks to have reached the limit as to how many specs, which is the non-club member, you know, this is not your whales in the insider club. This is the aggregation of funds, hedge funds, etc. They're non-club members, and it's how many can you trick into capitulating their longs, and to add short open interest, which you just described, they can do out of thin air. And it must be remembered that this spot to gold paper to physical unwind commenced at around 100 to 1. That's the paper to physical ratio. And as we discussed last time, it's important to take our focus away from the tick charts, which is every second, what's going on here, and to put Basel III Basel III centric sort of unwind action into context with the larger unwind of bearish open interest, which is a number of punters that have chosen to play in the casino. And as we highlighted in our last episode, there are far more unallocated gold contracts to square than the actual ability to one-to-one back them with physical without driving the price through the roof. Now, both squaring activities are actually occurring. But as we can see by the immediate action, and you can see it continuing here, much larger paper gold squaring is underway, which involves first selling the long paper gold position and buying back the dollar leg. And that's once more generated a false bearish read. Now, specs once again capitulated into the hands of these insiders who are one-to-one long against them. They have taken the long side of their capitulations. And just like last week, this will also be partly evidenced in the 3-day delayed COT report when it's published, which of course misses all the subsequent short covering into the Friday closes. Now, this is the question I get as well. But where do we see the equilibrium price? Given all of this gaming, what is the equilibrium price? And it's the balance of the psychological operation, of this open interest that is still willing or able to sell versus the optimum short covering point before unleveraged physical buyers lock in the spot price to take delivery against these insiders. And this becomes evident when futures becomes actionably backwardated. It has. Now, the equilibrium level in gold is 1750. And look, if you go back and you look at the Bank of International Settlements closes, i.e. on the last day of the month, April, last day of the month, June, as well as they started to fight the rise after the August 8th dump, you can see that's their equilibrium price. So anything below that is really, to be honest, I can't think anyone that I know of who would even think of dumping anything below 1750. They'd be looking to buy, or certainly maintain one's wealth by hanging on to that, and certainly aggregating in. And if you're a stacker, look, what have you got to lose? A stacker is not looking at a 10-minute chart. It's not looking at this kind of level of chart. It's looking at the bigger picture. So, look, spec short selling paper gold and related silver is obviously quite evident. And that's it. Look, there's two things. You have to legitimately hedge physical positions. So you'll see add shorts coming in to protect your physical positions, but also to momentum sell COMEX futures, which is what we're seeing. And that's what we're talking about. All these stops that are sitting there are very, very attractive. They're building there for the insiders to ultimately rinse. Now, look, COMEX specs, guarantee you, have zero visibility into the physical market. Look, it's just a dot on the screen. Oh, it could be zero. It really means nothing to them. It is. You've never sat inside a vault, never had to handle a bar, not to ever buy a bar. Basically, it's just a dot on a screen. So in doing so, this week, the specs have overrun some very important physical support levels. And that opens up both October gold, September silver, even December gold and silver to be competitively locked in by European and Asian traders. Specs will not know this. And the COT report will do very little to illustrate this. So they will continue to sell the rally. And that's what's happening. But this will provide a large short cover for these insiders and the BIS as they square off these unallocated contracts at the specs expense. Now, this week, as we moved into FOMC, paper gold was short sold below 1750 spot. In fact, they tried to do it again today, and really basically at this point here, we're just about $2 above it. But each time we've gone below 1750, we have, within the next morning, Asian buyers come in. We had extremely strong Indian demand appearing at the PM fixes, We've had Indian demand appearing at the AM fixes, which is primarily where India operates. We've seen sovereign size central bank buying appears, but basically against this wall of selling coming from the speculators who really just see this dot on a screen and are digging a hole for themselves. It is not the insiders doing the selling. This is the point. So they're rigging, but they're not selling. So basically, I mean, it's been more evident in the last 2 weeks into the fixes, as I say. So if you just look at the fixes, if you're that way inclined, where the unwinding of these unallocated contracts are benchmarked to be squared. In other words, that is the price you square them at. Now, these rigged fixes were orchestrated to maximize these efforts, as well as to psychologically operate and influence paper traders who have zero visibility into physical market strength. So really, I'm getting close to where we need to wind this up. I mean, counter to this paper-centric action that we are seeing here, and backed up by the option structure. So you know what? They do even expose themselves. If you care to do some homework, you can actually see that they're actually betting for higher. And we evidenced very strong insider buying on every bid pulling effort, with specs taking the short load into the insiders. Anything below 1800, they are on the wrong side. The options sweet spot is still 1810. In fact, insiders would be happy to see silver at around 24.5 into options expiry. So look, bottom line, if you're a stacker or you're seeking to protect your wealth, yes, I see this as a great time to stack physical into this paper dump. And this way, we become part of the solution.
Andy, I've got in my notes in big block, bold letters, buy physical. Not only buy physical, but understand the difference between what you affectionately call the casino paper and gold and silver markets, and between the physical and the paper. I like the way you say the casino paper, gold and silver markets versus, the physical gold and silver markets. They're just not the same. And I think that's the big, bold highlight that I have in here, especially because you just came out of the vault yourself. So there you have it. That's all we have for you on this episode. Another fascinating episode of Live from the Vault. Thank you so much, Andrew Maguire. And just before we go, make sure, if you haven't already done so, subscribe, hit the like, share this episode with everyone you know, and comment if you'd like to ask your questions. We'll try to get as many answered as possible on the next episode of Live from the Vault. Bye for now.